There's one year that changed our money forever, and most people have no idea that this happened even though we use money every single day. Wanna guess? No, it's not the 2020 pandemic. No, it's not the 2008 housing market crash. And no, I'm not talking about 1971 when our dollar was taken off of the gold standard. I'm talking about 1913. Yes, this sounds like a long time ago, but you're feeling the impact of what happened in 1913 today, because in 1913, two things happened. Number one, the Federal Reserve Bank was created, which changed how our money system operated. And number two, the federal income tax was also passed, which changed how much taxes you pay.
Every worker in the country, farmers, bank presidents, streetcar conductors, dentists, teachers, clerks, mechanics, even unskilled laborers, work 3 months of every year to pay for what government spends.
Before the year 1913, there was no central bank in the United States, and the reason why the Federal Reserve Bank was created, according to their website, was because it was to help, quote, a nation that was plagued with financial crises. Not to mention that before the year 1913, there was no federal income tax that was ratified in law. Now, just to have a little fun, let's talk about how your federal income taxes have changed over the years. Because in 1913, when the federal income tax was signed into law, the way it worked is you would pay a 1% tax on all income over $3,000. And then you would pay a 6% tax on all incomes over $500,000. So you can see that income taxes were a lot less complicated and a lot lower than what they are today. And I should also mention that this is based off of 1913 dollars. So if we translate this to what these numbers look like in 2024 dollars, this would mean that you would pay 1% in income taxes on all money that you made over $95,000. If you made under $95,000, you would pay $0 in federal income taxes. And then if you're a big baller, then you would pay 6% in federal income taxes on all money that you earned over about $15.9 million adjusted for inflation for 2024 dollars. So yes, income taxes have changed quite a bit, partially because government spending has increased quite a bit. And so to fund all the government spending, the government has increased your tax rates to make more money, to spend more money. Now at this point, you might be starting to see why some people are struggling with money today because of how our money system has changed over the last 110 years or so, but we're really just scratching the surface. Because the Federal Reserve Bank was originally created as a way to prevent banking panics. This is what it even says on its website, that the Fed was created in 1913 to print money to prevent bank panics. Which might have you wondering, why were those bank panics happening in the first place? And was the Federal Reserve Bank enacted to fix the problem, or just to put a little band-aid on it, which would eventually make the problem worse? See, what our economic system had long before 1913 is a banking system called fractional reserve banking. And what this means is if you go to the bank right here, and you take this $100 bill, and you deposit it into the bank, you think that this $100 is an asset for you. Because if you go and open up your mobile banking today, you know that the $100 is there and you can pull it out at any time. But although that $100 is an asset for you, it's actually a liability for the bank, because that $100 is money that the bank has to pay back to you. And the bank doesn't follow their own advice, because the bank's advice is that you need to save money, but the bank does not operate by saving money. In fact, what the bank does is they work by investing their money. See, they don't really tell you this, but the way that the bank operates is that they have to take this money that you give them and then give it away. And by giving it away, I mean investing it. Now, the way that the bank invests money is by lending this money. So if you give this $100 to the bank, what they want to do is get rid of it as fast as possible. And they want to get rid of as much as possible. So what fractional reserve banking means is that if you take $100 and you deposit it in the bank might keep 10 of the $100 and then lend out $90 to somebody else. So we'll draw this person right here with a mustache. In my native language, Punjabi, we call a mustache a much. So then this mustached man right here goes to bank number 2, because now they have this $90 to go and do whatever, and then they're going to go to bank number 2 and they are going to deposit this $90. Now this bank number 2 got another liability, right? For this person, the $90 is an asset, but for the bank, the $90 is a liability because this bank doesn't want to hold on to this $90. So then what happens next? Well, then this bank too is going to hold on to about 10% of this. They're going to hold on to around $9, and then they're going to lend this money out to another person because they want to get rid of this money as fast as possible. So then they're going to lend this money to this lady with a braid. In my native language, Punjabi, we call a braid a gut. And now she gets the other $81. And this goes on and on and on. This is called fractional reserve lending. But then this is where panic could potentially set in. Panic could set in if the people that are depositing money into this bank get worried. Maybe they get worried about the economy, maybe they're worried about the health of this bank. For whatever reason, they get worried. And then they go to this bank and now they start asking for this money back. Well, you can start to see why this is a problem. Because if everybody starts going to the bank and starts asking for their money back, the bank doesn't have the money to pay you. And this is called a run on the banks, and you can start to see how this banking problem could then cascade and domino effect into the other banks, because if people start pulling their money out of here, this bank might collapse, these people might get worried, start pulling the money out of here, and these people might start pulling their money out of the following banks and on and on and on, which then creates a banking collapse. And this is where the Federal Reserve Bank says that they want to come in to help prevent this. Now, you might have heard of something called FDIC insurance. What FDIC insurance says is that if you deposit your money in a bank, your money is safe up to $250,000 today at the time when we were recording this video. So if you have under $250,000, then you'll get all your money back and you have nothing to worry about. Well, FDIC insurance was created in 1933. About 2 decades after the Federal Reserve Bank was created. So now you start to see a little bit of confusion because the Federal Reserve Bank says that they were created to prevent banking panics, but in reality, banks rely on FDIC to prevent these sorts of banking panics. So what is the Federal Reserve Bank really there to do? And what the Federal Reserve Bank says is they are there as a line of credit to these banks if the banks start to run into these types of problems. So if Bank 1 starts to run out of money, they can go to the Federal Reserve Bank and borrow money from the central lender. That way, they have the money to keep paying out. But let's dig a little bit deeper, because over time, what we have seen is that things have changed. Kind of like we have seen that the federal income taxes have changed. The banking system and the Federal Reserve Bank has also changed as well. Now, we do want to remind you that if you are an investor, my team at Briefs Media publishes a free daily newsletter called Market Briefs, where every day, 6 times a week, my team is breaking down what's happening in the economy. That's the economy, the housing market, the stock market, the crypto market, and the global economy into a fun and witty and easy to read financial newsletter. It is completely free. We have hundreds of thousands of investors that read Market Briefs every morning. So if you have not joined Market Briefs yet, well, I got the link for you to join for free down in the description below. So let's build a little timeline. In 1913, the Federal Reserve Bank was created as a way to stop bank panics. In 1933, the FDIC insurance system was created to also stop these bank panics. In 1971, the United States dollar was officially severed off of the gold standard temporarily, which meant that our money was no longer backed by precious metals like physical gold, and our money became paper, which gave the Federal Reserve Bank the ability to print more money. Because before 1971, if the Federal Reserve Bank wanted to create more money, it needed more collateral in the form of gold to print more money. After 1971, it didn't need that gold. It could print essentially whatever amount of money that it needed to fund the government operations. So between 1971 to 2008, the Federal Reserve Bank was there to serve as a helping hand for the government to essentially help government spending and be there for that additional funding source for the United States government. But then in 2008, we all remember that we had this big recession, the 2008 Great Financial Crisis, where we had the housing market entirely implode and our entire financial system was on the brink of collapse. That happened in 2008, and for the first time ever, we now saw the Federal Reserve Bank do something completely different, which was QE, quantitative easing. And what quantitative easing was the Federal Reserve Bank was now printing money in order to fund these stimulus programs to boost the economy. So now instead of just helping the banking system and helping the government, now the Federal Reserve Bank is getting involved in the economy to help stimulate and boost the economy and print more money to get the economy moving, because in 2008, the economy stopped. The economy was a horrible, horrible situation because the entire market had imploded. And now what we're seeing happen today is that the Federal Reserve Bank is being used to fund any spending that the government can't get passed through Congress. Because normally when the government wants to spend money, they need to raise taxes. I mean, they have to get that money from somewhere. But if they can't get that tax approved through Congress, now what we're seeing happen is that the government is going straight to the Fed and saying, give us $1 trillion so we can go and fund whatever we want to do. And so now the government is able to pass these spending bills without going through Congress through the help of the Federal Reserve Bank, when originally it was there just as a way to stop the bank panics. But now let me tie this entire video together, because remember, in 1913, two things happened. On one hand, the Federal Reserve Bank was created. On the other hand, what else happened? Don't forget, it was the federal income tax that was ratified. Why does this matter? Because at the end of the day, all government spending is some form of tax. Because if the government goes out and spends money to, let's just say, build a bridge, somebody has to pay for that. Either the government is going to raise a tax on people to pay for this bridge, or the government is going to spend that money through the Federal Reserve Bank's money and then build that bridge. But if the government gets that money from the Federal Reserve Bank, who's paying for it then? Now this is where we have to go back just a little bit and understand that although they're called the Federal Reserve Bank, they're actually not federal. They were never intended to be federal, and even today on their website it says it's not federal. So they're not a part of the federal government. They're not a reserve because they're not sitting on any cash reserves. Remember, they're not the Treasury Department, they're not a part of the government, and they're not a bank. You and I can't go there to deposit money, so it's a little bit of a deceiving name. But they have the ability to essentially create money out of thin air. So now, if the government wants to build this $1 trillion bridge, and they get this money from the Federal Reserve Bank, well now, the government might not be able to get it approved from Congress, so we don't know where this money is coming from. It just comes from the Federal Reserve Bank, and then the government then builds the bridge. Which might have you wondering, if the government can just create this money out of thin air, why are we paying so much money in taxes in the first place? I mean, we have seen how much taxes have increased over the last 100 or so years. If the government can just take this money from the Fed, why do we need to pay so much money in taxes? And the reason why is because when the government borrows this money from the Federal Reserve Bank, it is still a tax. It's just now a hidden tax that doesn't always have to get approved the way that normal taxes get approved. And when I call it a hidden tax, what I mean by that is this is a tax in the form of inflation. Because when the Federal Reserve Bank creates more money, what are we doing? We're inflating how many dollars are out there. And when you increase how many dollars are out there without increasing the wealth, the value of each individual dollar goes down. Think of it this way. If you, me, and 3 other people, so there's 5 people in total, live on this planet right here. There's 5 of us, and each one of us 5 have $20. So there's $100 in this world. There's 5 of us people, and each one of us have $20 each. We're all equally rich. So we all own 20% of the wealth because we all own $20. But then let's say that the government here doubles all of our monies. They write us a check for $20 each. So I get $20 more, you get $20 more, and everybody else gets $20 more. Everybody has $40. Now you might feel like you just became doubly wealthy because you doubled your money from $20 to $40. But what you'll realize very quickly is that you really didn't become any wealthier, because all that has happened is the value of each individual dollar has gone down. Because all we've done is double the amount of dollars, double the amount of currency without increasing any additional amount of wealth. Now sure, maybe if you get that money early, you can go to the car and buy that car fast before the dealer learns about how there's more dollars out there and sees the impact of that. But eventually, that's what's going to happen. No one's going to be really wealthier than before because we just increase how many dollars are out there without increasing the wealth. And this is how Federal Reserve Bank printing, along with government spending, is a tax. See, all government spending is a tax. Somebody has to pay for it at the end of the day. Either it's going to be paid directly through a tax that you can see, and everybody knows where this money is coming from. Like if the government raised a 1% tax on all wealthy people, you know where that money came from. But when they spend that money through the Federal Reserve Bank, well now it's a tax that you have to pay through inflation, and now you don't know exactly who's paying for it. However, what we do know is the person that disproportionately pays the price is the person that doesn't understand inflation. And the reason why I say that is because inflation disproportionately hurts the average person, it disproportionately hurts the consumer, but it disproportionately benefits the investor. Investment values generally benefit from inflation, while consumption becomes more expensive. So what does that mean? in plain English. That means that when you go and shop, you buy the guac from Chipotle, it becomes more expensive. So for the people that are spending money, life is more expensive. But for the investors that own the assets, that own the stocks, that own the real estate, your investment values go up. And this is what we have seen happen, not just over the last few years, but over the last number of decades. That investment values have grown significantly faster than incomes. I mean, over the last 5 years, between 2019 and 2024, incomes have risen by around 20%, but the S&P 500, the stock market, has grown by around 90%. And if you say, well, Jaspreet, that's just because of the pandemic. Well, let's go back 5 decades. Between 1971 and 2021, household income has increased by around 600%. But over the same time, the S&P 500, the stock market, has grown by around 4,000%. Not to mention the fact that between 1971 and 2021, household income went from one-person households to two-person households, because in 1971, it was the man that went to work and the woman didn't, and in 2021, it's two people going to work. So, inflation is hurting the average person. The average person has no idea this is happening, but this is where you have to understand how our economic system works. That way we can actually win in this economic system, because the reality is the people that win are the people that understand the game. They understand the rules to the game. Well, most people never learn a thing. They don't understand how money works. They don't understand how the economic system works. They don't understand what investing is. They don't understand how to invest. But if you want to win in the game, you have to understand how to win in the game. And the way you win is by becoming an investor. Unfortunately, or fortunately, that's the rules to the game. Now, I'm not saying this so you love me or hate me. I'm saying this so you understand the rules, because these are things that I wish somebody would have told me. Because I went through a lot of schooling. I mean, I went through college and grad school and law school, and I never once learned a thing about money or investing or building wealth or our economic system. But the reality is people are working to make money. We can talk about all this hippie la stuff that people are working for happiness. Good, I want you to be happy. I'm not saying that money is the only thing that's important in life. But money is also important because everybody's working to feed their families, right? I mean, we're all working to get paid in some way. And so if everyone's working to get paid, you got to understand how money works, that we can have more financial freedom for yourself, because the reality is, if you don't have that financial freedom, you get stuck and you don't wonder why you can't break out of the system. And the first part is to understand how the game works, and then to understand how to invest your money. Now again, I have a free newsletter called Market Briefs where my team is breaking down what's happening in the financial markets, but I have a ton of free education on my channel where you can learn about how to start investing, different ways to invest. That way, hopefully, you can start investing your money and start building wealth for yourself. But just understand, markets go up and markets go down. Recessions happen. They've happened in the past and they will continue to happen. And while we do see market crashes, those create great investment opportunities for the financially savvy that can come in and buy the good investments when they're on sale. I just want to leave you with that piece. And with that, I'd like to learn from you. What would you like to learn more about? You want to learn more about how to invest your money in specific places, learn more about the economic system, or learn more about something else? Let me know down in the comments. That way we can work to create better content that helps serve you. Let's assume that you make $5,000 a month. After taxes, you will be left around $3,833 a month. Now, when you get this $3,833 a month, you pay your rent, you pay your mortgage, you pay your groceries, you pay for some nice stuff here and there, and then you have no money to save and invest. So this is what we're going to do differently.